We, of course, look at headline inflation, too, and that's our legal mandate. We look at core inflation when we're thinking about the path of future inflation, though, because it's just a better predictor. Many of the things that affect headline inflation don't actually send much of a signal about future inflation.
But for people who are trying to see where things are going, now that the labor issue where it is today, the predictive matter as it relates to future increases and the amount of those is really going to be inflation.
Inflation is going to be really important. You know, I think we're for quite a while here, we've been in the range of achieving our maximum employment goal, and we're only just getting there with inflation. I think I wouldn't declare victory on that yet either.
Yeah. It's really been difficult, I think, for many Western countries to get to a place that they're comfortable in inflation, which brings me to the wage issue. Look, I like my colleagues, I'm very concerned about wage stagnation, and I'm not in any way trying to offload that issue to you. We all have responsibilities to put in place policies that will hopefully cause all Americans' wages to increase. But what we're seeing here, and what we're seeing actually, let's face it, in Western countries around the world, is people are not, the anticipations that people had relative to where they were going to be in life is not being achieved, which is creating some extremes as it relates to the political environment, actually in some ways beginning to destabilize because people are rightly so concerned about the fact that they're not really increasing the ability to raise their families as they wish. Let's talk a little bit about that. I mean, what is it from your perspective that is causing us to be in this place where the economy is growing, but for the last 30 years, Americans really haven't seen the wage gains that they'd like to see? Could you just lay out, not in any way to take responsibility at the Fed solely yourself, but what is driving that?
You know, it's the stagnation of middle-class incomes, the relatively low mobility that we have, the disappointing level of wages over a long period of time. It's all of a piece, and it all does go to that. And I think the causes of these things are really deep. It's not something we can address really successfully over time with monetary policy, as you say. So I mean, I think it's,
what are those deep causes?
So I think you know, part of it is, in our case, in the case of the United States, stagnation of educational achievement, the leveling out of educational attainment. When U.S. educational attainment was rising, technology was coming in, it was asking for more skills on the part of people. They had those skills, and so you had productivity rising, you had incomes rising, you had inequality declining over a long period of time. U.S. educational attainment flattened out in the 1970s, and everywhere else in the world it's been going up. We really had a lead. We were the first country to have gender-blind, secondary education universally. So that's a big thing. It's really the only way for incomes to go up over a long period of time is through higher productivity. Really, that's real incomes go up over a long period of time because of higher productivity. Higher productivity is a function of, in part, the educational and skills and aptitude of the workforce. It's also, partly the evolution of technology and investment. I think right now, in particular, we had a number of years of very weak investment after the crisis because there was no need to invest. That weak investment period is casting a shadow over productivity right now, which is one of the main factors that's holding down wages. So these are deep, hard problems, but I mean, education is really at the bottom of the pile.
And I'm glad you alluded to that, and my time's up, I know, but we actually have had productivity growth without wage growth.
Over long periods of time, the only way wages can go up sustainably is with productivity growth. They don't necessarily match all the time. I mean, since the crisis ended, productivity growth has been, output per hour has been very, very weak. Increases have been very, very weak.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.